A lot of us have been thinking really hard about an important question. Is the stock market overvalued? That is the $1,000,000 question. No, truthfully, that is the $1,000,000,000 question. And while this is the face I make when I'm thinking hard, for this question, I don't have to make that face. And the reason for that is because I know the answer to the question. Is the stock market overvalued? You better believe it is. But what I don't know is whether or not the stock market's going to make a correction. These things can go on for a long, long time. So in today's video, I'm going to share with you why I think the stock market is likely overvalued now, and more importantly, what it means to you and I and what we should be doing based on that. I've been a financial advisor for over 20 years. I want to share this information with you so you can prepare and protect yourself. So let's jump in. First, why do I say the stock market's overvalued and why do I say it so confidently? Okay, and I follow some really smart people. I know a lot of you do as well. Two of the smart people that I have a lot of respect for is Robert Schiller and Warren Buffett. You've probably heard of Buffett. You may never have heard of Schiller. Schiller is a professor at Yale School of Management, and he has a valuation measure that, frankly, I wish I had thought about. It's called the CAPE ratio, the cyclically adjusted PE ratio. And that sounds complicated. Don't tune out because basically what it means is let's look at the cash flows that companies have produced per share of stock over the last 10 years. Let's not just look at the last quarter. Let's not just look at the last year, but let's average that out over the last 10 years. And let's look at what investors are willing to pay for $1 of cash flow. That's essentially what the CAPE ratio is. And let's track that historically. And here you can see the CAPE ratio for the S&P 500. And importantly, on this chart, there are um, bands with the standard deviation. So how out of normal is the current valuation? And you can see we're about 1.5 standard deviations outside of the norm rate now. And so that is Schiller in his example, and you can see what it is historically. You can see what it was in 1999 when a lot of people got hurt. It's not there yet. It's not there now, but could it get there? And just the fact that it's so high above the historic average. Okay, now let's switch gears and talk about a wise a wise voice, a wise investor that most of us have heard of, Warren Buffett. And Warren Buffett says, you know what, I've got a different valuation measure, and it happens to be my favorite measure as well. And Warren Buffett says, let's look at the value of all the stocks in a country, and let's divide it by the gross domestic product of that country. And so here you can see the Buffett indicator. It's 55.81 trillion is the value of the stocks in the US, and it's let's call it $29 trillion for the gross domestic product, which gives us a Buffett indicator of about 2x, 200%. And so how does this compare to the historical average? And again, I've got another chart. Both of these charts, I want to thank Current Market valuation for producing these charts. But you can see here, we're right at 2 times standard deviation away from the mean. And if my high school statistics is not failing me, that puts us in the top 5% historically of all valuations. Now, what does that mean, though, right? What does that mean to us? Well, let me start by saying what it means to Warren Buffett. And I don't have a direct line into Mr. Buffett, but what I can see is how his company that he manages, that he invests for, what are they doing? And you can see this is his company's Berkshire Hathaway, and you can see this is their total cash and cash equivalents as a percent of their market cap. And you can see right now it's at 21%. And how does that compare historically? You can see it's at the upper end. And in fact, that number has continued to go up since this chart was created. So not only is Warren Buffett obviously looking at the indicator that he thinks is most important, but there's times he has a saying, um, be be fearless when other people are scared, and be scared when other people are fearless. And right now, there's a lot of fearless people in the stock market. In fact, as I record this, it's going to date it, but Bitcoin has just hit an all-time high, and that Bitcoin to me represents it represents a lot of things, and I'm not an anti-Bitcoin person, but it does represent an investor's appetite to take on a speculative investment. And I say that because it's really hard to value Bitcoin. So to me, it represents a speculative investment. I'm not saying whether it's a good thing to invest in or not, but it is a measure of investors' appetite for risk. And right now, investors are hungry. They've got a ferocious appetite. And I know for myself, when I have a ferocious appetite, when I haven't been eating my 3 squares a day and maybe I've not eaten all day, boy, when I have a ferocious appetite, when I'm really hungry, I oftentimes make bad decisions on what I choose to eat, and investors might be doing the same thing right now. So what does all this mean to you? That's really the key question. So as I record this, over the last 2 years since the October 2022 lows, the S&P 500 is up about 60%, 60%. That's a big number, and that's a good thing, right? Many of our accounts, even if you're not 100% in the market, and many of us should not be, this is not financial advice, I don't know your situation, but even if you're half in the stock market and half in bonds, boy, that 60% return over the last 2 years has really helped us out a lot, right? Has helped us make up some ground, and unfortunately, salaries aren't keeping up with inflation, but at least our stock accounts have been doing very well over the last 2 years. But what this means to most of us is we've likely may have I shouldn't say likely, we may have gone out of balance. If we have a 50-50 allocation, because our stocks have done so well, maybe we're at 60-40 now. And boy, it's a lot easier to balance things out, to go back to your long-term asset allocation strategy. It's a lot easier to do that. It's not painful to do it when the market's at all-time highs. Where it's painful to do it is when the market has fallen 20, 30, 40%, and maybe you've given up $100,000 of gains in your stock market. Think about how long it took you to save that first $100,000, which is what causes some of the mental anguish. And I'm just making up numbers. If the market falls 30% and you're 50-50 stocks and bonds and your bonds stay stable, that means we've lost 15%. And if you have $1 million in your portfolio, that's $150,000. So I'm just giving general numbers, but it causes angst. And unfortunately, the closer we get to retirement, and certainly once we're in retirement and we no longer have new money coming in, it becomes more and more painful to see a loss like that because frankly, we can't take advantage of the losses. We're actually taking money out. So we are now forced sellers into a down market. And there's a couple things that cause people to be forced sellers. One is they need the cash flow, and the other one oftentimes is just the pain of loss. People, ah, I can't believe the market was at an all-time high and I didn't rebalance, and now I've gone through all this pain. And sometimes people will say, I want nothing to do with stocks anymore. I don't want that to be you because then the anguish, the pain of loss is causing you to be a forced seller in a down market just to cause the pain to stop. I don't want that to happen to you, which is why I'm sounding this alarm now. The stock market, at worst case, is very healthfully valued. And I'm sorry, in the best case, and in the worst case, it's overvalued. So it's important we make good decisions, which is why I made this video here on a different topic, which is once we have enough money to retire, when should we retire and why waiting to 65 might be a big mistake. I'll see you in that video. Bye bye.